Yeah, so it is going to be a story of just how much extra supply, so new listings come on, and how much extra depth of demand is in the market. So think of it like that, and then you can think about that macroly, but you're wasting your time. You really just want to be looking at that in terms of isolated markets, right? Because it is absolutely a story of markets within markets. Always remember the broader story there, though, is that there's a chronic undersupply that doesn't look like it's going to fix itself in the next 2 or 3 years anyway. So that bodes well for both value pressure on the upside and also an improving rental income story as part of that. Now, as each day goes past, we're feeling more confident about the risk of another rate rise is sort of diminishing, but rates staying at this sort of higher level for a little bit longer is a real story. And we do know that at some point, APRA will have to move their 3% buffer rate. So they are definitely controlling the ability for people to be able to borrow. So that ultimately can also have some medium-term upside in terms of future demand. So when you are buying, where you buy absolutely matters. And so we'll continually keep pushing the story about markets within markets. All right. And so when we talk about those markets, we think that Perth and regional WA will finish the year in very, very good shape with some further short-term price growth. We think Adelaide and some of the regional commutable areas to Adelaide from its regional areas will do reasonably well. But the message is just starting to get out there in terms of their rental reforms, and that's not going to be well liked in terms of the ability to manage and run your small business property. It's going to add to costs. So make sure you do your research around that in terms of how much control you're going to have of your rental property in South Australia for the short term. Southeast Queensland continues to see that growth. It's a general growth story around strong population going into that particular market. So that will continue to do well over the sort of medium term, as well as more people choose to live there for lifestyle reasons as well as affordability reasons. Regional Queensland. Now, Queensland is an enormous state. So I just want to give a warning, and I promised this at the start of the episode, around tropical North Queensland and those areas through climate change risk, flooding, and obviously severe weather event risks happening in those particular markets. What a lot of people don't do when they're doing their due diligence is to get a quote on what their insurance premium will be, whether it be for a standalone property or as part of a body corporate. And in Queensland, it's law that you have to have the building insurances and all of those types of things. And they are astronomical. They are ridiculous. It's so bad that the federal government is trying to put an underpinning sort of, insurance policy or underwriting those premiums that allow those premium prices to go down. But this is the warning that we were saying to you before. Yes, we're in the business of buying investment properties for the long-term capital growth and the passive rental income that comes off those properties. Yeah. However, if we don't get that rental income coming off those properties, then it hasn't delivered that, because we're paying higher land taxes. We're paying more government fees and charges. The council start charging higher rates for investors, all that dumb stuff that then basically disincentivizes investors from coming into that market to provide the critical amount of rental accommodation that a city or a regional town needs to continue to keep building itself up. People aren't just going to walk into a city and buy. They're not going to walk into a regional town and just buy. So the less amount of rental accommodation you have, the less chance you have of economic growth and economic sustainability. So always be mindful of that, regulators and governments, when you think about taking a quick win of an ATM through, from an investors using us as ATMs. I stumbled through that, but we got there in the end. All right, next, let's go to Sydney. Sydney's got enough activity to sort of happen there to sort of say it'll probably peter out or be flat, or it might not, in terms of my prediction, it's probably a flat market with maybe a 60-40 downside risk for a little bit of correction by the end of the year if interest rates don't change. The no grounds eviction stuff could also be interesting in terms of buyers' confidence as they get their head around the legislation. It's still not quite out yet, so we haven't seen what would be reasonable grounds, because they're going to have to seriously consider that, because talk about a big rental market. Sydney is one of those for all of those people coming into that city and trying before they buy. Melbourne is very much a story of challenge around its economic activity and also around the appetite around the reforms that are happening around the higher land taxes and so forth. But that's a short-term point of view. This is where I will say, for those people who invest counter-cyclical, Bryce and I are still very, very strong when we take a 10, 20, 30, 40-year view. Melbourne is a mega city, as is Sydney. They are still in the top 105 population centres in the world. They are mega cities. They find a way to continue to keep developing and growing, and that puts pressure on long-term land values and ultimately puts pressure on long-term capital growth on the upside. So if you don't have something in Melbourne in your portfolio, looking at how affordable it is, you're going to see a lot of property investment commentators talk about how Melbourne is affordable, but that is not a proud thing to be proud of. It's affordable because effectively the economy is starting to falter. And once the government infrastructure spend slows down, it's going to have to be relying on business and small businesses and all those things continuing to move the economy forward. And so that's why there is a question mark in the short term over Melbourne. But if you're playing the long game from a counter-cyclical point of view, you're going to be buying in that market with less competition, which means you've got more negotiating power in that particular market as well.
And it's not inevitable that all the properties are going to go down, Ben. It's just
No.
the science is in the fact that averages mean some go up, some go down. So it's not buying in massively into the narrative that there isn't opportunities that exist, and that's, I guess, where that asset selection comes. But to your point, I think it's really important that it is a big city. It's a mature city. It's driven largely by owner occupiers because it's so mature. And to your point, the stats we put up before had Sydney getting more net overseas migration, but that's unusual. Melbourne gets more than its fair share of the people that want to come to this country and live here as well. So I think, again, to your point, there is a counter-cyclical argument here, but some markets will do, some suburbs and some locations and some properties, even some suburbs might go flat, but some properties within those suburbs. So it becomes a selection game.
Yeah, the population story ultimately does drive that demand story as well. So I just put that graph up for people to study if they're watching the video recording of that. So that's true. When I don't give an update on Canberra because, again, it's just too expensive. The whole regulatory and market interference in that market gives me zero confidence that that's a market that I would want to put my money into, even though it has really strong employment because it's all government workers and they get higher incomes. You're just giving all your money over. You're giving all your rental income over to the governments in higher land taxes and fees and charges, and minimum standards are ridiculous in that town as well. So that's a big pass for me. I was mentioning before about Darwin in terms of its story really is an economic struggling story. So the economy is struggling. The politics in that state is always challenging in terms of what's happening, but the rental yields are obviously incredible. So if you're thinking about commercial versus residential in terms of the trade-offs you might get from a rental and passive income point of view, that would probably be in the mix for those people who are happy with a little bit more risk appetite in terms of looking at that particular story. When we go down here for downside risk, it's the sticky inflation story that we've always talked about over the course of the last 12 months. And that's people not changing their behaviours because conditions are pretty good. I've still got a job, so I'm going to keep spending. A higher interest rate for longer, and that's about testing that sort of depth of demand that we were just talking about. So that's some downside risk, and it's that political and regulatory interference that I keep talking about and banging on about. It does change people's attitudes and confidence and behaviours around whether they invest their money through, if they're going to continue to put higher taxes and charges on investors. So that's a really important point. And to finish off on our final word, and we did mention it a fraction ago, is that we play the long-term game. So property still remains the most attractive way in which Australians express themselves. It's still the biggest barbecue conversation. And so for those aspiring Australians and successful Australians, they show their wealth through their homes, their renovations, the shows that we watch on television. Property is a big part of our DNA. And while that remains the case, Owner occupiers will continue to drive that story, and investors should be smart enough to get on the coattails of that and enjoy that growth that comes from those people wanting to live in areas, prepared to pay to be in those particular locations and enjoy the lifestyle drivers that come with that particular story. So as investors, when we're thinking about that, that ultimately turns up into land value, and that gives us the confidence that over time we're going to see continued strong economic growth of the nation, and then ultimately that will then flow down into land values, which will ultimately, result in those strong capital growth returns that we're looking for, and eventually the passive rental income of these days $2,500 a week on the back of indexation. Years ago, we always used to talk about $2,000 a week, but we are going to move that up, obviously, to accommodate for the time. So that just gives you a bit of a wrap, Bryce, in terms of how we're seeing the market, and hopefully that's informed our community for that, where they see opportunities in the second half of this year.
At least until we get to February, Ben, and we get to update it again, which will be nice. But to quote the great Jan Summers, buy the right property, correctly finance it, and hold it for the long term. And to quote Charlie Munger, you don't make the money in the buy, you don't make the money in the sell, you make the money in the wait. So I think that's a nice point. But look, there's opportunity there for people who are open to borderless, looking for other opportunities, and staying the course. It's a cash flow game under 10 years. It's not a balance sheet game. So I certainly like some of the points that we picked up there, and we've got a lot of clients that are taking advantage of certain parts of those markets. We've got lots of clients, Ben, who also have property in the Melbourne marketplace, and so we're continually getting them to lift their eyes and remind them that they're playing this game for a lot longer than the next sort of 12 to 18 month news cycle, which I think is important. And you and I both have property in the Victorian market that
we
we're
do.
not planning on offloading anytime soon. In fact, not at all. So